Good morning, everybody. Good afternoon to our East Coast attendees, and happy lunchtime. Rob Barnes with Integrated Insurance Consulting. Today is a brand new presentation, all case studies in life insurance and business, and I'm going to get rolling. So, we today the case studies that we're dealing with are all applications and designs of life insurance used in business settings. They're actual client situations I've been directly involved with. All of them are viable strategies where life insurance helps secure the business and the families involved. Life insurance is simply a tool providing leverage and liquidity. It offers unique benefits, including power of contract, tax-deferred growth, tax-free proceeds, and protection from creditors in many states. I don't know if you're aware of the show The Profit on cable. I like watching it. Marcus Lemonis is a self-made billionaire. He's the current CEO of Camping World, and he has a mantra that he preaches of any new business owner that it's all about process, product, and people. Certainly, good people are important. And in the financial service business, though, we all seem to be working with the same products, and therefore, in financial services, the process is often the product. So I want you to know that IIC is positioned to help you in a transactional or an advisory capacity. Many of our client situations that are brought to us by advisors are simply implementing the coverage that you've recommended. We instantly make your clients professional shoppers. We can also be professional designers when you need the help. We can work with you directly or with your clients or all of the above. We've been serving advisors for more than 25 years, and so some of the stories we'll share go back that far, and we'll not only share how it started and how it progressed, but we have some of the endings as well. And I want you to understand that when we engage your clients, we have a process that we utilize with them. I understand you can buy life insurance in many formats these days, but often these programs come with surprises for any client that's not in perfect health. We have to take all comers in our world, whether they're in good shape or not. And then I'm on staff at a national insurance brokerage operation, and we know that underwriting is not the same, and how you work the system absolutely matters. Our unique positioning allows us inside access to carriers and underwriting. And our pre-screening process helps us with accurate pricing and carrier selection. It takes money and good health to buy life insurance, long-term care, or disability coverage. And our process helps us manage the expectations each step of the way. And when coverage is placed, we do deliver a kit, and we track important dates like rate locks or conversion expirations on term insurance. And so as we go through these cases, you'll see how important proper maintenance and follow-up can be with certain client or policy situations. And so at the heart of what we do is make your clients expert shoppers. We manage expectations. We get it right the first time or the second time, or sometimes we have to go further. We'll share a policy kit and track important dates. And so this is a good time for me to let you know I'm not an attorney nor an accountant. So here's our process stories. To start with, key person, educate and design, a couple policy reviews, and a second opinion situation. So our first case regarding key person coverage, and to better define key person, it's often used to protect a company from the sudden death of certain employees that move the bottom line. It can be an owner or a non-owner. It's often management executives, research and development executives, production executives, or key sales reps within the company. And key person is utilized for securing loans, recruiting, retaining, rewarding key people, redeeming shares, providing salary continuation programs, and additional compensation for the key people. So our first story starts as key person for four business owners that created a new business and they were just looking for a short-term band-aid situation in case any of them die along the way. But their plan as young gentlemen, because they all came from other startups before, they're looking to cash the chips in within 10 years. So they didn't really care about quality term insurance at all. They wanted lowest price. And we had some issues. Several of the gentlemen were pretty big for their build. We had some marijuana usage and medical history that caused us to use three different carriers in the mix. And this is what it looked like. We put the first two owners at company A, and the third owner went to a different carrier, and the fourth to a different. And this was all due to the pricing and how these carriers saw each different risk. And so this coverage was placed through a fee-based advisor in 2023. And we knew because health can change over time, both good and bad. Usually it's bad, but there's a couple situations where health can improve if the client's trying to make that happen. And weight loss is one of those, and quitting smoking is another one. And so two of these gentlemen were on diets. One of them was doing a lot better than the other one. And so we came back a year later and lowered that premium from 16,000 down to 11,000. Now we're still tracking this case. That premium might go down a little bit as he loses a little more. The second person wasn't doing as well, but he had also some other health issues. But so far, we started at 41. We were able to get him down to a $36,000 premium with monitoring and reapplying for a rate reduction with the existing carriers. So our first tech tip is employee-owned life insurance. These rules stemmed out of a Walmart janitor situation way back when. Walmart owned insurance on a lot of their employees. And when the wife of the janitor found out that the company got a death benefit, but she didn't have any life insurance on them, she raised a stink about it. They still kept the money, but it did change the business owner landscape out there where you can't just buy on every employee. It has to be certain employees. So you have to be a director or larger than 5% owner or have a large income, be one of the highest paid officers, or among the top paid employees in the business. And so what is instilled now is if you don't document, disclose, and report these things, when somebody dies, that death benefit might become income taxable. So we'll include this EOLI kit that we share with business owners when we're working with them. And if the company owns the coverage, this applies. That's even if it's a sole proprietorship, to be very clear. So it's sometimes for small businesses why we won't own coverage in the business. And it's something that might change you to want to do ownership in a different format. And we'll carry more on another tech tip here. But we make sure that we get the document and disclosure form signed and we deliver a copy to everybody. And then it's up to the company to file Form 8925 each year showing that they own insurance on some key people within their organization. So moving on to our second case study, this one I'm calling Educate and Design. It coincidentally has four business owners as well, and it's a more recent case, but this was a situation where these four gentlemen already worked at the firm and they were now buying out the founder of the business and carrying it on. They were going to be equal owners. And unlike our last case, they were thinking long term here. They wanted to have quality term because they knew someday they might need to own the coverage. And they also wanted to be all at one carrier if they could be, but we had to price everybody with our screening process, and we delivered this grid to them, and we showed them that, hey, we can put you all one place, but since owner D has some issues and other carriers are more favorable with marijuana usage, we can save you 6,000. They did end up taking that, and they have two companies now three of them at one, the other one at the company that was more favorable with underwriting. But it's quality term, and we're going to be discussing that shortly, which is often important for business owners or higher income, higher net worth people to have a hedge on their future. So in this situation, these owners didn't have to worry about this new Connolly decision. We'll have something in your packet about this as well, but it used to be that any coverage that you had for buy-sell continuity planning was not also included in your taxable estate, but that changed with Mr. Connolly. Unfortunately, the money that went to redeem his shares through the life insurance proceeds, not only was his estate taxed on the value of the company, but it was also taxed on that insurance. And so it's causing some buy sells to change or be set up in different ways. When you have a higher net worth person, instead of having the entity own the life insurance, we might look at cross purchase, or we might have a trust own the coverage. And the piece we'll send you will help you identify and perhaps notify some people that are in this place. Now, it didn't pertain to case number two because they didn't have a high net worth yet. They took out a lot of debt to buy the business, and they are younger, but we have them on a check-in every 5 years, and at some point in time, they may need to change their buy-sell and get the coverage out of the company if their net worth and business value grows down the road. So a lot of what we do for people, or one of our cherished services for advisors, is to help you review existing or proposed insurance on your clients. And we can review, analyze, or evaluate that coverage. And our next two stories are policy review stories. Keith and Kathy are longtime people that I know. Keith is a fee-based planner, and as his business grew, as he was successful, as he was max funding all of his 401k plan that he had available, he ended up buying some variable life insurance. He needed the extra protection, but he heavily funded it for the start to make it another accumulation vehicle. But somewhere along the way, he stopped funding the variable, and his business continued to grow where he became a high net worth individual. And so a number of years back, he asked me to review his existing variable life policies. We had to get in-force ledgers and look at how things went. And because he was in a different mode, he was not income replacement anymore. He was estate tax planning. And I know the hurdles have climbed recently for the federal government, and he doesn't have that exposure. He hasn't been that successful, but he's in the state of Illinois where there's still tax. And so we ended up reviewing the variable life, and one policy was in better shape than the other one, but long term, unless they earned much better than a 6%, one policy was going to not be around, being eaten up by the internal mortality charges to it, no matter how well it performed. And so you can't 1035 individual policies into a second to die. And we also didn't want the coverage owned in the taxable estate anymore. He was in estate tax planning mode. And so he set up an irrevocable life insurance trust. We took each of the variable life policies on both Keith and Kathy. We annuitized them over a 10-year only horizon, spreading the tax over that time. He was able to net $17,000 a year from that, and his intent was making annual exclusion gifting of the $20,000 premium. He obviously had to kick in the $3,000 difference out of pocket, but what we did essentially was turn those policies combined into $1 million liquidity for the kids. And depending on when they die, Kathy was 57 and the healthier of the two. So if she goes at age 87, it's a 6.3% IRR. If she goes later in year 35 or 40, she's a 5% or a little bit under it. And when you look at these IRRs, it's just important to understand that life insurance, again, owned properly outside the estate, is completely income and estate tax free. And if you're comparing to investing, you have to gross it up by the management fee and any taxation. Remember, a trust is at the highest tax rate with just a little bit of income, and that's why you often see irrevocable trust funded with life insurance as a good wrapper for it. So in his case, we replaced underperforming VUL policies. We eliminated the estate tax exposure on the life insurance. We increased the death benefit versus the combined variable death benefits, and we replaced projections with guarantees in the situation. He was happy about it. Now, our tech tip number three here is that 1035 exchange rules. You have to have same owner, same insured, or annuitant when you're dealing with annuities. And you can go life to annuity, which we did in this case, but you can't go annuity to life because of the way taxation works. And you can't exchange individual coverage into a second to die. And so we had to use the vehicle of that SPIA. We didn't have to, but it just made it on autopilot and safe, steady return so that he had the money every year plus the 3,000 to gift to the islet and fund the second to die policy. Now, our second policy or our second review is going to really show my age. I mean, my tenure in the business here. I met Mr. Big early in my wholesaling career. I worked at an individual company at the time, and we've been in the brokerage arena a long time. He was a wealthy real estate business owner, and he also happened to carry his life license because of the getting life insurance every once in a while to cover his collateralize his loans and such. He wanted a piece of that action too. But what was our benefit was that the company I worked for was one of the first companies that lent him a big amount of money to buy an apartment complex, and he always remembered that. And so when he wanted to buy his life insurance, he came to our company, and I was the local territory guy, if you will. And so I was still learning the advanced markets in life insurance. So I had a manager to help with the arrangement that we set up for him, which was a blended whole life policy using split dollar. Split dollar is a way to utilize the corporate dollars in his planning, and he preferred to use that checkbook versus his individual. And things were going fine along the way, but 10 years later, the product of guaranteed universal life entered the marketplace, and we went back and looked at our blended whole life people and said, can we improve things? And it ended up being very beneficial for him to replace his blended whole life with a guaranteed UL. We were able to unwind the split dollar arrangement, and that means pay off what was loaned, increase the guarantees, and lower the premium. And so this is what that policy looked like. We rolled over the net cash after unwinding the split dollar. We had a $120,000 premium, but this was one of these cases where you don't just put it in a drawer and forget about it. We need monitoring. I was the agent on this case on his behalf that he ended up not having his insurance license any longer. He kept growing his real estate fortune. And 8 years into the policy, they came to me saying, hey, we've got some cash flow issues in the business. We'd like to lower this premium if we could. And so a guaranteed UL policy is very sensitive to the timely delivery of the premiums, if you will. And I like to call it permanent term as well because it doesn't have to accumulate a lot of cash, but yet it can be guaranteed as long as you pay those premiums timely. And so we ended up lowering the guarantee from lifetime down to age 95. He was adamant he wasn't going to make it past then. And we did that. And time went along, and in year 12, the trustee skipped paying a premium that year. I had done some in-force ledgers showing that, hey, the guarantees are lowering here. And long story short, she also then skipped three more premiums in years 16 to 18. And what happened then was unfortunately Mr. Big had a major stroke, and he was didn't look like he was going to pull out of it. And because the trustee knew that she had skipped those last three premiums, she mailed a $300,000 check. And there was some clerical thing where the bank ended up not cashing in the check. And she called me all disturbed. My dad's gonna die soon. And I know you were telling me the coverage might be shortened and all that. And long story short, I told her that we had enforced ledgers that showed that the policy was still going to run to age 91. You don't have to pay those last three premiums. That's the flexibility of these kind of policies as well. You might fund them for a long life, but if health changes, you can lower or maybe stop funding was the long and short of it. So we saved her that 300,000 in premium. Unfortunately, he passed a little bit later, and we delivered the death claim. So when I look at this with hindsight, we now know how it turned out for him. The 2005 policy, that was a 7.13% internal rate of return, premiums versus the death benefit delivered. And if I take it all the way back to include the whole life component, it's still a 5% return. And that's generally what you'll see with a lot of permanent policies is they're a bond alternative. Remember, to outinvest the policy that was tax-free, you have to gross it up by management and taxation along the way. And it's not really fair to compare a stock portfolio with a fixed policy. There's variable life insurance if you want to load and use the tax deferred wrapper for it. So I became friends and looked up to Mr. Big, and sorry to see that he's gone, but that's going to happen to all of us. Our next case was a second opinion case. My group benefits guy brought me in because his firm that he did benefits for all the time, they just paid somebody $5,000. And at the end of the day, the suggestion for all of the corporate owned policies that they were auditing was simply to exchange them into variable universal life. Now, that was taking them from one extreme to the other. They had full guarantees with the whole life policies. He took them to full risk. You see, there's three risks in any life insurance policy. There's premium payment, there's performance, and there's mortality risk. And so he took them from a very safe thing into it. That's why they wanted a second opinion. They weren't really comfortable with that when they looked at ledgers and saw that the bucket could run dry and the coverage could be gone. And so we did a little bit more of education of the flavors of life insurance, and we looked at what they did, what they had, excuse me. Now, the whole life they had, it wasn't necessarily bad, but it wasn't as good as when they first bought it because the carrier demutualized along the way, the dividends deteriorated, and we showed them the animal of guaranteed universal life. You can instill all the guarantees if you don't care about the cash reserves and not going to use that for living benefits. We were able to lower the premiums and increase the coverage, and we gave them pure protected coverage, which is what they really wanted at the end of the day. So, again, we're here to give second opinions as well. And this is a situation. It started in '08, but I've been called back in to help because we've had new executives and retired executives. We had a death or two along the way, including one earlier this year. And back in 2020, they instilled some more insurance on the new CFO. As the other one retired, they were buying that guy out over time. And for the new one and a couple execs, they bought accumulation life insurance and they were heavily funding it because they needed the reserves to buy out people as they retire over time. And so the person who died in 2025 was already retired and being partially bought out. Now they have the proceeds for the policy they own to buy the rest of him out and reimburse them a little bit on the money that they saved. So along the way, one of their locations has on the building that they were established in 1930. And I complimented the COO and CFO that I was working with at the time because I knew that they worked hard to work on the business. They weren't just lost working in the business every day. And that's why this company is still going strong and will be called back in again and again here. And what I want to emphasize with the chart on the right-hand side is when you add multiple lives, the chance of a death is even greater. Now, I think there's about seven execs that we have insured there for the life insurance. And again, already had a death and retirements and so forth. So, with that, I'm going to pause for 1 second. If you came in late, we need you to log 50 minutes to get your CE hour. When you log off of the program today, you will get a pop-up in your browser that asks you to take a survey. We appreciate you filling in the full thing, but at least fill in your CFP code or let us know that you're not one so we don't delay filing for everybody else. Excuse me 1 second. And we appreciate you letting us know new topics. This is a brand new presentation. Our last month one was all case studies in the annuity arena. And we put our presentations up on our YouTube channel so you have them and can look at them. You'll get a copy of this along with a kit of information. And so I'm going to carry on. I know I'm speaking at a fast pace, but we want to get through the content. So it's hard to be a really good life insurance company these days, and there's fewer companies that do a lot of things well. So quality term starts with good financials and ratings, a good product portfolio, good reputation out there. We want certain policy features we look for quality term, and it at the end of the day protects your future and flexibility. And life insurance is different than when I started in the business, if you will. Now we can add riders to cover for long-term care, and you can hedge those with some of the term policies and that. So it's a very interesting, the arsenal of supply that we have and the things we can create and build for you and your clients. So at the essence of it, quality term gives you an option to lock in your good health and keep options open longer in case things didn't work out like you planned. And so essentially, how long do I have to change things or convert my coverage, and what options do I have to convert to? Those are the two bigger questions. And I wrote an article a while back for NAPFA magazine, and I did a redo on it in a recent newsletter that I sent out, and it was titled something like "Quality Term is Harder to Recognize." Well, today it's even harder than then, and fewer carriers cover it. And if you in some situations demand quality term, in my opinion, business owners are one of those. Higher income, higher net worth people would be another category. But if things always don't go like the plan does, and quality term hedges your options. So for those in the real estate business, you might look at it as a rent to own scenario. For those in the stock and bond, you might look at it as a call option to get something different down the road. But it's important to know what happens after a rate lock on term insurance. The policy might end, the death benefit might drastically reduce. The typical, most common we see is the premiums increase, and they increase drastically. This is why we track term insurance and check in with you that, hey, your client bought a 10-year term and we're in the ninth year here. Next year they're going to get a frighteningly higher, well, in the 10th year, excuse me, they're going to get a frighteningly higher premium. You might want to reach out to them. And so our next story is quality term saves the day. This was a situation I worked with a fee-only advisor on. I was brought in. They were building out a buy-sell agreement amongst the two business owners at the time. They weren't sure if they were cashing in the chips or if they were going to have the next generation take over. So they just bought 10-year term insurance, figured that they'd figure it out along the way. One of the gentlemen was 60 years old at the time, and we showed them the smorgasbord of all the carriers that we had, and explained to them the difference between cheaper term and lower price term and quality term. And they agreed that they wanted quality term because it hedged their options to adjust the plan if they decide to keep the business in the family. Well, 5 years into the plan, one of the partners, now 65, was diagnosed with a life-shortening disease. It was only a couple years later when he couldn't perform any of the duties and needed nursing care, quite frankly. And so 10 years can roll around pretty quickly. And what I knew about their policies was one of the policies was going to have a huge step up in cost, and the other policy was going to have a huge reduction in the death benefit. And we absolutely couldn't let that happen on policy B. So that policy had to be converted. And you can see here that the $7.5 million death benefit was going to go down to 783. And looking at the different options we could convert to, we ended up converting to a product that we were funding it for 5 years, but it was guaranteed to be around in 10 years. And we were pretty sure he wasn't going to make it that long. We weren't sure it could have been any time now, but long story short on him, he ended up living 5 years into this. So 15 years after I met a very vibrant executive at age 60, he was gone and struggled along the way, no doubt. His other policy didn't have to be converted. They could have paid the ART premiums on it, but when you notice year 11 was 303,000, it made sense to convert these policies because we stripped down a UL to mock term for 10 years, and we had a $111,000 premium the full time. Again, he went 5 years into it. So we did end up paying out the 15 million, but this executive out of the two bought 3 million personal, and we delivered the claim check on that as well. So it was their decision to buy quality term, but I took the time to educate them and showed them the array of pricing. And so a warning to always buy the cheapest price. We've always learned buying quality matters, right? This was one of those cases where it was vital. Now, this case, excuse me, this case gets more involved because the buy sell that they were setting up actually started as a cross purchase. And along the way, they started to have some feud in how things are running and who's doing all the work and all these stuff. So they wanted to unwind the cross purchase. And when you change ownership on a policy, our tech tip number 4, we'll have this in your kit too. You have to be aware of transfer for value issues and exceptions. So one of the exceptions is the insured. And if you transfer for value and somebody dies, the death benefit might be taxable as the punishment. So you know that. In this case, we had cross-owned policies, A owned on B and B owned on A, and we knew that the insured was a exception to transfer for value, so they transferred each policy back to the insured. But because of the executive that was now ill, was now doing estate planning with their trustee and a person who had power of attorney there, and they had certainly attorneys involved here. They wanted to get his insurance outside of his taxable estate into an irrevocable trust. And so they didn't want to gift the policy because if you gift, you'd have a 3-year look back. And it ended up we needed to value the policies to sell the coverage to the irrevocable trust and avoid that 3-year rule. And so there's 3 different ways to value a policy. You can use the PERC test, which is premiums plus earnings minus reasonable charges. You can use interpolated terminal reserve, which is something you get from the carriers. You can use market value and life settlements. Anyway, we assisted the attorney on this stuff with the policies so that they could do their job. And when he passed, this money was not in his taxable estate. It was in the irrevocable trust and leaving legacy for the family. Our next case comes from a fee-based advisor. He was certainly capable of selling term insurance and such to his clients, but he ran into a business continuity situation that was a little more involved. He asked me to come in and help with the clients, and we earned our trust and value from the clients along the way. To my knowledge, both of these gentlemen are still alive. And at the time, Executive A was the younger of the two. He was the majority owner at 75%. And they just wanted business continuity, stock redemption kind of coverage. And so we did place this coverage on them back in 2012. These are now paid up policies, the 10 pays that we've designed, and the insurance, the term insurance. Well, since then, I know that partner A totally bought out partner B as he retired. But there was another part of this where the life insurance conversation came into play. You see, a lot of people they commoditize insurance and such, and the only for sure in life is death. And so life insurance is a different conversation with people. Executive A had a whole life policy. And he came to us and he said, I haven't done what the market tells me I should have performed at. I've had less with my investments, but this whole life policy I've had, it's increased every year, no matter where interest rates were, no matter what the stock market did. And I like safe, steady stuff like that. I have enough risk in my life with just running this business. And he wanted to buy more whole life insurance, was the long and short of it. And we talked to him about the concept of split dollar. And we said, there's a little thing with split dollar and putting a life insurance policy in an ILIT on your behalf and you being the business owner and the insured on the policy and stuff, where potentially the death benefit could come back into your taxable estate and negate the power of getting it out of your estate. So he took that, and that was with help of the attorneys at the carriers, guiding us through things and delivering that information to him. But he went to his attorney, and $15,000 later, the attorney told him the same thing I did at the start. And he wanted him to spend even more on a private letter ruling to make sure that this coverage would be out. Well, anyway, by this time, the client was a little bit perturbed over it all, and he said, well, forget this split dollar strategy. I'm just going to buy the policy on my own. He created a spousal lifetime access trust and he bought a $5 million whole life policy, 10-pay premium, because he wanted more safety and growth. And he was in legacy mode. He was significantly wealthy. He still has an estate tax thing. And we're potentially working on the transition of the business to the kids, is what I understand from the main advisor here. But this is the policy that he purchased in 2014. It's a paid up policy now. He just used his lifetime exemption to make the gifts to it. And it's a bond alternative, whole life insurance is. Now, I know a lot of people confuse the terminology of whole life with permanent, but permanent insurance has many flavors. Whole life is just one of them. But whole life is the only policy that's scientifically designed to work with the reserves in the policy. And at the heart of what whole life does is the death benefit's going to equal the cash value on a guaranteed side by age 100 or 120. Note in his policy, if I may, real quick, that at age 100, his policy with all the growth, the total cash was going to equal the total death benefit if he lived that long. And he knows it's a bond alternative, but again, gross it up by other things. It's a better return than you think because it's net net. In this case, not only guaranteed cash value is going to equal the guaranteed death benefit at 100 or 120, depending on the policy, but the total is going to equal, and that's what I just showed you. And so, what I want to bring up here is that often working with business owners is also working with high net worth people. And you can come in and do business planning, but it helps to know the estate planning and vice versa. I work with high net worth people that own businesses and it helps to know it. In fact, I think it's malpractice if you don't get a good understanding of one versus the other. So this is something that is up on our YouTube channel. It's the opening of our presentation next month on high net worth and life insurance planning. But I want to just quickly go through that the estate tax formula is it's everything you own minus what you owe plus your life insurance proceeds. That's what equals your taxable estate. And this is why you often see life insurance moved outside the taxable estate. And The estate tax laws tell you a lot of things, but essentially, if you've been successful in America to a certain extent and above, and I know they just raised the bar on federal estate taxes, but there's a number of states that still tax you, including mine. And essentially, the tax laws tell you that you can pay a max tax, and that's how you can contribute to society. But you can self-direct your social capital and get to the other end of the field where there's no tax. You just have a lot of work to do in between. And so you have to set up living trusts and powers of attorney and healthcare powers of attorney and guardianship and trustees and executors. You'll use lifetime gifts and irrevocable trust, spousal lifetime access trust, life insurance, qualified personal residence trust, sales to intentionally defective grantor trusts. You might use family limited partnerships or family LLCs or grantor retained annuity trusts or private split dollar premium financing. And along the way, lots and lots of attorney fees, no doubt. But here you are in the red zone, and all you have to do now is give the rest away. And then you'll pay no estate taxes. You'll use charitable gifting, charitable lead trust, charitable remainder trust, and family foundations. And the fact is, very few people ever get to the other end of the spectrum because of all this work and because of their need to control things. And so that's why a lot of people use life insurance or use it as part of the plan or a main part of the plan, if you will. It has tax advantages of growing tax deferred, received income tax free, estate tax free if you own it properly, and it often can be the most economical way to create the liquidity needed when people retire. Onwards with it, the worst asset to die with people, whether or not they have an estate tax, is qualified money. And Dr. Slat is somebody that I met through his career life insurance agent. And we were actually in there to talk about long-term care. And the reason we were was he already owned some whole life insurance through his agent. He was adding some more term because he was also the owner of the business. He already had a large qualified balance in his 401k, and he knew that he, needed to get assets out of the estate now. And believe it or not, with his wealth and income and everything, he wanted long-term care insurance. He was regretting that he passed up the opportunity to buy a lifetime benefit policy because he hemmed and hawed on it and they were gone from the marketplace. And so we were in there because we still had an option for that. And we went through traditional and hybrids and life with rider. And he ended up buying life with rider because he understood it was a known outcome and that the money he was gifting wasn't going out the window. He was either going to use the death benefit for care because he had $1 million. He could access 20,000 a month if he became chronically ill. And we designed things both for him and his wife. They had similar premiums that they were paying to age 65. And so in this situation, for people with large IRA balances, we know that the stretch IRA was taken away. And I don't know if you caught, but an article by Ed Slott, who works with retirement plans a lot, he came out with an article after the stretch was gone titled that life insurance is the new stretch IRA. The point here is that when you see that somebody has a large IRA and other assets, all they're doing is building up a tax time bomb. Whether or not they have an estate tax, that qualified plan is still going to be income taxed, right? And so getting and shedding wealth outside of the estate using life insurance leverage might be a good thing to do. Now, I'm not saying stop contributing to your 401k, but if you already have a good balance and you have other assets and pensions and things like that, maybe you reduce what you're doing up to you don't want to forgive you don't want to forgo any matching on it. I don't get that ridiculous. I know some people in my business go off that edge. I don't do that, but it's all about just creating and understanding estate tax laws And today we have a large exemption federally, but we still have 16 states that tax you when you die, including this one. If you a dollar more than 4 million, they tax you from dollar one. And Dr. Slat lives in Illinois. And so he understood what he was doing. He already owned spousal lifetime access trust where his term insurance was. He was already in mode of, I have more than I'm going to need in my lifetime. I'm still working and doing great. And so that's what he did for his long-term care. We minimize bad assets because qualified money shrinks if you pull it out for long-term care. You don't know where the market is when you have to liquidate. We gifted and leveraged money, owned it right outside where it won't cause additional tax for him. And he's got tax-free money if and when he needs it for care or legacy. And it's an uncorrelated asset. It doesn't matter what the markets are going to do. He's got it. The only thing we're missing for Dr. Slat is when does he die? And if he dies at age 88, it's still a 4% net return. If he needs care around then, similar kind of a thing. And this is excuse me, something to think about for your clients that are younger and doing very well. Does the tool of life insurance add value to their situation? So we're winding down to our last couple of stories. Please add your questions to the Q&A. We'll get to as many as we can. I am going to run past the 50 minutes here, but hope that this is worthy to give you our last two. Mr. Franchisee was introduced to me by a family member of his that was also an insurance agent. And he knew he needed some extra help on advanced stuff. And long story short, this was the classic situation of having to have liquidity. And not having it could have been disastrous here. But I met him when he was 60 years old. He had over 20 locations of a franchise that we all know the name of. His daughter was expected to take over the legacy. He was in a second marriage. None of the kids were from that marriage, but it was a long and stable marriage. And so wife was treated equal here and priority above the kids, quite frankly. And he had three other kids that he wanted to take care of, and he had state and federal taxes. And he needed liquidity. At the end of the day, he ended up buying a 10-year term policy. He bought quality because he wasn't sure of the outcome of things. And he bought 5 million. He probably could have used more from the situation. But this is the thing with business owners and the cost of liquidity and the tool of life insurance that's perfectly situated to be delivered when you need it the most. A lot of people start out under the today pie, where the business is the overwhelming portion of their estate. They aspire to get to 20 years from now. But think of this guy. Even if half of his business was half of his estate, he needs to leave that to the daughter working in the business, or he wanted to. He needs to leave money to the other three kids. He needs to pay federal and estate taxes, federal and state estate taxes, I should say. And then he needs to keep the wife involved. And so anyway, we know the ending of this story because I think this was a COVID repercussion as well. But his 10 years just happened recently, and now he's 70, and he's got a whole different plan than what he thought of 10 years ago when we started. He expects to sell most or all of the locations in the next couple of years and fully retire. The daughter might take one or two locations and be happy, or she might rest on the money that she's cut in on as far as her percentage of ownership. The wife won't have any business concerns because she'll have the pile of money. Now, there's still value to having life insurance from where I come from, but the client doesn't see it that way. His attorney says you can just liquidate your investments to pay any tax that you need. And he's going to still have a little bit of federal tax, even at the new levels here with where his wealth had grown to. But he's certainly got the state tax, and that's going to be 16% of his full value. And so he chose to lapse his policy and he didn't want to carry on any coverage. So this is where the need for and the cost of liquidity is often misunderstood or miscalculated. And the point being, if he wanted to maintain the company in his estate, then selling assets wasn't an option. He certainly didn't have a lot of assets outside of the core business, certainly not enough to pay all the taxes. and he could go borrow, but you don't know what the loan rate would be. And again, think of it, he's passing away, and the daughter would be the one to have to go borrow to buy out the business from the estate of dad. And you don't know where the interest rate levels are going to be. Go back to 2008. Not only were rates higher, but you couldn't get credit so easily. And so the often one of the better, more economical ways is to insure. Think about it this way: you prepay some of the interest in the form of premiums, and we give you the principal when you need it. So our last story is going to be the cobbler kid shoes. This one's a little personal for me because I go way back with both of these advisors. And in 2009, they started a one-way buyout for the transition of their financial services business. They were a fee-based company. I worked with them and their clients along the way for many years. Partner B, junior, if you will, was buying out senior, so they wanted coverage on her. You couldn't buy a 20-year term at her age, so we bought a universal life and designed it to mock a 20-year term. And Partner B didn't buy any insurance at that time in 2009, even though I told him, well, if you die, then that messes up her retirement and it could extend or bring her back into the business and stuff. And she's going to have to find a new partner to grow and trust with and all that. But he was resistant to insurance. And along the way, he started owning the majority of the business and running the show. He got married, he built his dream house, he had kids. And from 2009 to 2018, I kept tapping him on the shoulder about buying his own life insurance. He finally submitted and bought coverage in 2018. And both of these people have passed away. In 2023, the senior partner died in a crash. And earlier this year, I when I called to check in with him on something, I found out that he died from a heart attack. So um, it just shows that we as advisors, are we doing the things? Are we walking the talk with our clients? I've seen a lot of change in this business. When I started, we were known as the widows and orphans friends, and now we're looked at as useless to some degree with some people. The business has become so commoditized, you can buy life insurance at Costco these days. But I saw the trend years ago that agents were becoming advisors and advisors were becoming fiduciaries. And so there's less people in my space of selling life insurance. Less people want to do it, less people know how. And so if you're not bringing up these protections with your clients, who's going to, or who's going to work with them? And I know that there's some resistance to the fact that I primarily work on commissions, but I like to look at it simply as I'm only paid when the plan is implemented. So I hope that you're walking the talk with things. I just, for sake of time, when I hear resistance, like Junior here didn't want to buy insurance, I ultimately found out what his situation was. And he told me, you know what? My dad never owned life insurance because he always thought that if he bought it, he'd die right after. And I said, well, you're going to die whether you own life insurance or not. And maybe I cursed him because 7 years after buying it, he died suddenly. But this is a little checklist to work with yourself or your clients when you're dealing with insurance. Are they in denial? Are they ignorant? Can we educate them past this? Why are they procrastinating? Where are they stuck? Or are they just being stubborn? And feel free to use that acronym. My last thing for today is, although this was life insurance focused, there's three options in life. You're going to live, die, or become disabled. If you live and are worried about outliving your money, that's why we work with lifetime income annuities to help you. Die is obviously life insurance. Becoming disabled has two components to it. While you're in your working years, we can replace your paycheck. But if you become disabled to the point of needing care, what's going to pay for that as well? And young people become chronically disabled. It's not as likely. We think about it as an old person's thing, but these are the areas that we hope help you with. And so want you to keep those in mind. At the end of the day, I want you to know that we can do document review for your business owner clients through the attorney partners at some of the carriers that we work with. We can also do company valuations. They're not binding like a full appraisal would be, but they help out. And this is an area of expertise with estate planning that I've long had. And so, anybody can work with your super healthy clients and that, but it's a smaller crowd that can help you with these. So, before I get to questions, I want to thank you for taking time to learn with us today. Our next presentation is high net worth and life insurance on 11/19, and we're going into designing life insurance, going through the different chassis, give you a better understanding, a little bit of history of the life insurance world on 12/17. And we partner with advisors, help you serve your client protection needs. We offer experience, knowledge, and compassion. Simply put, we know and we care. So again, if you came in late, stay for the Q&A here, but I'm going to stop the recording and then look at our Q&A here.